Picture two investors sitting at their kitchen tables right now, both staring at the exact same Bitcoin chart. One of them is watching his portfolio bleed and already drafting a post about how crypto is finished. The other one is quietly moving money into position, not panicking, not celebrating, just executing a plan she built months ago. Same chart, same data, completely different conclusions. And here's the thing that should stop you cold. The second investor isn't smarter. She just understands one framework that the first investor has never bothered to learn. Bitcoin is down 24% year to date as of early March 2026. That is not a rumor. That is not FUD from some anonymous Twitter account. That is the actual number. January came in at negative 10.2%. February followed with negative 15.1%. 2 consecutive red months to open a calendar year. That has never happened in Bitcoin's recorded history. The fear and greed index is sitting deep in extreme fear territory. The headlines are doing what headlines always do, screaming that the sky is falling. And if you are watching this right now, there is a real chance you are feeling exactly what those headlines want you to feel. But here is the twist that nobody in the financial media is leading with. Some of Wall Street's most credible Bitcoin analysts, the ones with institutional money behind their research, not just YouTube thumbnails, are calling this the weakest bear case Bitcoin has ever faced. Bernstein, one of the most respected research firms covering digital assets, is still maintaining a price target of $150,000 by the end of 2026. Not despite the weakness. They're aware of the weakness. They are looking at the same 24% drawdown you are looking at, and they are not flinching. That contrast between the emotional temperature on the street and the analytical temperature in institutional research is exactly what this video is about. Here is what I am going to show you today. I am going to walk you through Bitcoin's 4-year cycle framework in enough detail that you will never look at a red month the same way again. I am going to show you the historical data from 2014, 2018, and 2022, the years that felt like the end and turned out to be the setup. I am going to lay out the two competing narratives that serious analysts are arguing about right now, with specific price targets and specific logic behind each one. And then, I am going to give you 3 clear scenarios for the rest of 2026, with probabilities attached, so you can make a decision based on structure instead of fear. Because fear is not a strategy, and neither is blind optimism. What actually works is understanding the pattern. Let me start with the framework that makes all of this make sense. Bitcoin does not move randomly. I know it feels that way when you are watching it drop 15% in a single month. But underneath the chaos, there is a structure that has repeated itself with remarkable consistency across 3 complete cycles. It is built around the halving, the event that occurs approximately every 4 years and cuts the rate at which new Bitcoin enters circulation exactly in half. The most recent halving happened in April 2024. And if you understand what the halving does to the supply-demand equation, everything happening in 2026 starts to look less like a disaster and more like a chapter in a story you have already read. The 4-year cycle breaks down into recognizable phases. Year 0 is the halving itself, combined with a period of accumulation where prices are generally depressed and retail interest is low. Year 1 is the bull expansion, the phase where prices move dramatically higher, new all-time highs get set, and everyone who was quiet during accumulation suddenly becomes a genius. That was 2025. Bitcoin peaked at approximately $126,000 in October of last year. Year 2, which is where we are right now in 2026, is historically the peak and distribution phase, transitioning into what the cycle framework calls the reset. And year 3, which would be 2027, is the full bear or consolidation phase before the next halving sets up the next cycle. Understanding which year you are in changes everything about how you should be reading the current data. The numbers from past cycle year twos are not pretty, and I am not going to pretend otherwise. In 2014, Bitcoin dropped 85% from its peak. In 2018, the drawdown reached 84%. In 2022, it hit 77%. These were not gentle corrections. These were the kinds of drops that made people swear off crypto forever, liquidate their positions at the absolute worst moment, and then watch in disbelief as the next cycle erased all of that pain and then some. The pattern in each of those years was the same. Post-peak capitulation, followed by extended sideways chop, followed by a grinding recovery that most people missed because they had already given up. Now, here is where 2026 starts to get genuinely interesting. We are already 47% off the all-time high of $126,000. That sounds catastrophic until you put it next to the historical comparisons. In 2022, at a similar point in the cycle, Bitcoin was also in the process of a major drawdown. But the structural conditions underneath were fundamentally different. In 2022, there were no spot Bitcoin exchange-traded funds. Institutional infrastructure was thin. Corporate treasury adoption was a concept, not a reality. The ecosystem was running on retail enthusiasm and leverage, and when the leverage unwound, there was nothing underneath to catch the price. That is not the world we are living in today. If this is already shifting how you think about what 2026 actually represents, not just a bad year, but a specific, identifiable phase in a repeating cycle, drop a comment right now. I want to know what you are rethinking. Because the investors who understand cycle positioning are not looking at this chart the same way the headlines are telling you to look at it. They are asking a completely different question. Not, is Bitcoin dying, but where are we in the pattern, and what does the pattern say comes next? That question has a specific, data-backed answer. And the answer is more nuanced and more actionable than anything you are going to get from a fear-driven news cycle. The 24% year-to-date drop is following the script. The 2 red months are following the script. The emotional exhaustion you might be feeling right now, that is following the script too. Every past cycle had a moment exactly like this one, where the data looked bad enough to justify walking away, and where walking away turned out to be the single most expensive decision an investor could make. I am not telling you what decision to make. I am telling you that the decision deserves to be made with the full picture in front of you, not just the part that fits on a fear and greed index. The full picture includes something that the bearish headlines are not giving enough weight to: the structural transformation of Bitcoin's investor base between 2022 and now. More than $135 billion in assets under management sitting in spot Bitcoin exchange-traded funds. Corporate treasuries holding Bitcoin as a reserve asset. Banks with regulatory approval to offer custody services. These are not marginal developments. These are the kinds of structural changes that alter how a market behaves during its weak phase. The floor is different now. The question is how different, and that is exactly what the competing narratives are fighting about. So let me give you both sides of that argument, because you deserve the honest version, not the cherry-picked version that confirms whatever you already believe. The bull case starts with supply. After the April 2024 halving, miners are producing approximately 450 new Bitcoin per day. That is half of what they were producing before. Meanwhile, The spot ETFs alone were absorbing somewhere between 1,000 and 3,000 Bitcoin per day during their peak inflow periods in 2025. You do not need a PhD in economics to understand what happens when demand outpaces supply by that kind of margin over a sustained period. The halving does not create an immediate price explosion. It never has. What it creates is a slow motion supply squeeze that takes 12 to 18 months to fully show up in price. We are right inside that window. The analysts at Bernstein are not pulling $150,000 out of thin air. They are doing the math on reduced issuance, projected ETF inflows, and the historical lag between halving and peak price. The math gets you to a number that sounds aggressive until you run it yourself. The bull case also leans heavily on the corporate treasury angle, and this one is newer than most people realize. MicroStrategy, now rebranded as Strategy, holds over 500,000 Bitcoin on its balance sheet as of early 2026. That is not a trade. That is a conviction bet so large that it has essentially turned the company into a Bitcoin holding vehicle with a software business attached. And they are not alone. At least a dozen publicly traded companies have followed their playbook, allocating portions of their cash reserves into Bitcoin as an inflation hedge and a differentiated treasury strategy. When corporations treat Bitcoin as a balance sheet asset rather than a speculative trade, the selling behavior changes. These are not retail investors who panic at a 20% drawdown. These are CFOs with board-approved treasury policies who are not touching their positions until the thesis breaks. And the thesis, for most of them, is a multi-year hold. Now, here is the bear case, and I want to give it real weight because dismissing it would be intellectually dishonest. The bear case says the cycle is breaking down. It says that Bitcoin's growing correlation with risk assets, specifically the NASDAQ and broader tech, means it no longer operates on its own internal clock. It says that when the Federal Reserve tightens, when macro conditions deteriorate, Bitcoin goes down with everything else, regardless of where it sits in the halving cycle. And the data from early 2026 gives this argument some traction. The January and February drops did not happen in a vacuum. They happened alongside a broader tech sell-off, driven by interest rate uncertainty and renewed inflation concerns. If Bitcoin is now just a high beta tech trade, the 4-year cycle framework becomes a historical curiosity rather than a predictive tool. The bear case also points to on-chain data that is genuinely concerning. Long-term holder distribution, meaning the wallets that have been sitting on Bitcoin for more than a year and are considered the most conviction-driven segment of the market, showed elevated selling activity in late 2025 and early 2026. When long-term holders sell, it typically signals one of two things. Either the price has reached a level where even the most patient investors are taking profits, or confidence in the near-term trajectory is eroding. The data is ambiguous enough that you can read it either way, which is exactly why the two competing narratives exist. Here is my honest read on where those two narratives stand right now. The macro correlation argument is real, but it is not new. Bitcoin has always had periods of high correlation with risk assets, particularly during acute macro stress events. What the historical record shows is that these correlations tend to be temporary. They spike during the fear phase and then decompress as the macro situation stabilizes and Bitcoin's internal supply dynamics reassert themselves. The 2022 cycle showed this clearly. Bitcoin fell hard alongside tech in the first half of the year, when the Fed was hiking aggressively. But the recovery phase, when it came, was driven by Bitcoin-specific factors: the halving anticipation, ETF approval speculation, and accumulation by long-term holders, not by macro tailwinds. The pattern suggests that macro correlation is a short-term override, not a permanent replacement for the cycle framework. That brings us to the 3 scenarios I promised you at the top. These are not predictions. They are probability-weighted frameworks for thinking about the rest of 2026, and I want you to hold them as tools for decision-making, not as guarantees. Scenario 1. The cycle holds and the recovery is already underway. In this scenario, the January and February drawdown represents the sharpest phase of the post-peak correction. The bottom is somewhere in the $55,000 to $65,000 range, already potentially in or very close. The second half of 2026 sees a recovery toward the $100,000 level, with Bernstein's $150,000 target achievable by year-end if institutional inflows reaccelerate. The probability I would assign to this scenario, based on the structural arguments above, is roughly 35%. It requires macro conditions to stabilize and ETF inflows to resume at meaningful scale. Scenario 2. Extended consolidation with a later recovery. This is the base case for most institutional analysts who are not making aggressive directional calls. Bitcoin finds a range somewhere between $55,000 and $80,000 and grinds sideways for the majority of 2026, with the real recovery push coming in late 2026 or early 2027 as the next cycle's anticipation phase begins. This is actually the most historically common pattern. The post-peak year tends to be long and grinding rather than a sharp V-shaped recovery. Probability: approximately 45%. This scenario rewards patience and punishes people who need constant price action to stay engaged. Scenario 3. The bear case wins and the cycle is genuinely breaking. In this scenario, macro deterioration accelerates, institutional buyers pull back, and Bitcoin tests significantly lower levels, potentially the $40,000 to $45,000 range before finding a real floor. This would be the deepest drawdown of the current cycle and would shake out a significant portion of the retail investor base. Probability: roughly 20%. It is the least likely outcome, given the structural changes in the investor base, but it is not zero, and anyone who tells you it is zero is selling you something. What do you do with those three scenarios? That depends entirely on your time horizon and your risk tolerance, two things only you can define. But here is the framework the second investor at the kitchen table is using. She is not trying to call the exact bottom. She is not waiting for the chart to look safe before she acts, because by the time the chart looks safe, the opportunity is already repriced. She is sizing her position based on the scenario she thinks is most likely, keeping reserves for the scenario she thinks is second most likely, and accepting that the third scenario exists without letting it paralyze her. That is not a complicated strategy. It is just a strategy, which puts her miles ahead of the person reacting to every red candle with a new thesis about why crypto is finished. The investors who built real wealth in 2020 and 2025 were not the ones who predicted the exact bottom in 2018 and 2022. They were the ones who understood the cycle well enough to stay in the game when staying in the game felt the most uncomfortable. That discomfort is not a signal to exit. In every previous cycle, it has been the most reliable signal that the setup is forming. The question is whether you are going to be the investor who looks back at March 2026 as the moment the picture became clear, or the one who looks back and wishes they had seen what was right in front of them. There is one more thing worth saying before you close this tab and go back to checking prices every 20 minutes. The single most destructive behavior in every previous cycle was not buying at the top. It was not even panic selling at the bottom. It was the in-between move, selling somewhere in the middle of the drawdown, locking in a painful loss, and then watching the recovery happen from the sidelines while convincing yourself you would get back in at the right time. That right time never felt right, because by the time the chart looked clean again, prices had already moved 40, 50, 60% off the lows. The psychological cost of sitting out a recovery you saw coming but did not act on is something that does not show up in any portfolio tracker. But it shows up everywhere else. Think about what happened to the investors who sold Bitcoin in January of 2019, when the price had already dropped from $20,000 to around $3,500, and the narrative was completely broken. Every headline confirmed they were making the smart call. 6 months later, Bitcoin was back above $10,000. 12 months later, it was pushing 14,000. And by the end of 2020, it had blown past the old all-time high entirely. The people who sold in January 2019 did not just miss a trade. They missed the entire next chapter of the story, the chapter that made the previous pain completely irrelevant. That is the chapter we are potentially setting up right now. Not guaranteed, not certain, but structurally consistent with every previous version of this moment in the cycle. The data is not asking you to be reckless. It is asking you to be honest about what phase you are actually in, rather than letting the emotional weight of 2 bad months rewrite your entire thesis. 2 bad months in a 4-year cycle at a historically predictable point in the pattern, with more institutional infrastructure underneath the market than has ever existed before. That is the full sentence, not just the first 2 words of it. So go back to those 2 investors at their kitchen tables. The difference between them is not intelligence, not access to information, and not luck. It is one thing: the willingness to zoom out far enough that the current moment stops looking like the whole story. The chart that looks like a disaster in the short frame looks like a buying opportunity in the long one. Which frame you choose is entirely up to you. But now you have both of them.